G'day Fools, I'm Scott Phillips, the Motley Fool's Chief Investment Officer here in Australia, and welcome to another Stock of the Week on YouTube and of course on the Motley Fool Money Podcast, wherever you're viewing or listening. Thank you for joining us. The Stock of the Week is our marquee series here at the Motley Fool. So we pull back the curtain just a little bit and give you a look at not only a stock that we've recommended to our members for free, by the way, but also the rationale and the reasoning behind it, some of the risks. We're trying to give you a bit of an insight. Hey, free stock pick's always good, but also so you get a bit more information about the way we go about our research, our recommendations, things we look at and listen to, the way we try and beat the market with our investing. And I'm joined by one of the very best in the business, the Motley Fool's Director of Research, Kevin Gandiya. G'day, KG. How are you, mate?
Hey, Scott. I'm good. Thanks for having me.
Pleasure, mate. Thank you for joining us again. I always enjoy these conversations. I've got the best job in the world, just quietly. Don't tell anybody else, but I get to sit and talk to you blokes about some of your favourite stock picks for, nothing. I just ask hopefully reasonable questions. I sit back and take it all in. But the good thing is our viewers and listeners get to do the same thing as well. Now, today's company is a business that I knew originally as Uniti Wireless. But when you sent the link through, it was just Uniti all of a sudden. The ticker code is the same. It's UWL. I'm going to assume it's no longer as wireless as it used to be, or maybe it just has plans to be bigger and better than just its core original business. But rather than me assume, rather than me guess, how about I ask you, because you're the guru, you know this business better than almost anybody. Tell us about Uniti today, bit of its background, bit of where we are today, bit of what it does and what it offers for its customers and obviously suppliers, partners, and everybody else.
Yeah, that's great. And I think that's a fantastic question because Uniti Group IPO'd around 2019 on the ASX. At the time, it was known as Uniti Wireless, and that's because it was predominantly a wireless internet service provider. Mm-hmm. And there's nothing too exciting or interesting about that. But the management team over the years have gone through a series of transformation and acquisitions within the business and really transformed the business now into a core infrastructure business. So now they're pretty much an infrastructure company. Their core business provides fiber to the premise infrastructure. If that sounds familiar, that's because that's exactly what the NBN does. Right. And so this is a company that competes directly with the NBN, and pretty much between them and the NBN, they are a duopoly, which means that it's just those two companies within the market trying to do exactly that. So that's what the company does today. The management team is pretty much a very experienced telecommunications management team. They've worked at places like Vocus and TPG and M2. So they really know a lot about the Australian telco market. And certainly have done well to really build the business to where it is. They acquired, Scott, a business called Opticom. This was a company in high demand with all the big infrastructure investors, particularly the super funds, and integrated that Opticom business into Uniti Group. So now what they have is the total package. They can provide that infrastructure. They also have retail service offerings, and they also have a communications platform that they offer for their business. And they provide their services to both businesses, commercial, and to residential premises as well. And their business model pretty much is to partner with property developers like Meriton. And what they do is when properties are being constructed, they sign those contracts up front to provide the fiber to those buildings. And then once the construction is complete and people move in, they can plug away straight away and connect to the internet. And that creates, I guess, a recurring source of revenue for Uniti because, hey, we all need the internet. How often do we change our? You can change the service provider, but you actually don't really change the core infrastructure that supports your internet. So it's a really interesting business, and I'm happy to chat more about it.
Very cool, mate. I like it a lot. I can see why they went from Uniti Wireless to Uniti. There's no point going to Uniti Wireless plus wired because it kind of covers the spectrum. So that makes some sense just to take that name off. I'm also fascinated that I have to say, and whether you want to talk about this or not, there was the Vocus M2 Amcom days for those investors who remember back about a decade or so, and it kind of at that point felt like the end of the race. The idea that kind of we'd carbon fibered everywhere. We'd kind of, we got to the point of saying, we're done. We don't need any more of this stuff. Of course, things change and Uniti pops up, not only pops up, but continues to grow apace, acquire, build, grow, consolidate. It's a remarkable story of, I guess, I won't even say it's rising from the ashes, but that idea of I was one of those people who said, okay, the fiber race is done. Not carbon fiber, just fiber, of course. Carbon fiber is the bikes. But when we get to then Uniti's growth, it's pretty impressive. Let's talk about that, mate, in the context of the investment. This is a buy recommendation of you and your team at Motley Fool Extreme Opportunities. I'm not sure it's recommended elsewhere in the Motley Fool universe. It may well be. So we are talking our book to some degree, but more importantly, we've already recommended this to our members, and we still think it's a market-beating investment from today's price. So the question then is, why do you guys expect it to continue to be a market beater?
Yeah, and I think when we first recommended it to our members, the question was, why is extreme investors recommending an infrastructure business? And
yeah, right.
The simple reason is this is a very unique business. It combines really strong growth with a very core and defensible business. It's really hard to displace what these guys are doing. And so when we look, I think when you look at the first stage of this company's growth, it was really about that consolidation phase, actually building what they have today, going from a wireless business into an infrastructure company. That was stage one. And I think where we're at now, looking ahead, we're actually looking at a business that has everything in place and is starting to grow more organically. So when we look at Uniti Wireless, they have more than 250,000 properties that are under contracted and on the books and still waiting to be constructed. So as those buildings are constructed and the construction there is finished and people move in, that's revenue that's going to come online for this business. And also what they do is when they move, typically when a property development is taking place, particularly with the big developers, there are also adjacent opportunities, shopping malls, schools, hospitals around the near areas. And again, those are all areas where Uniti is providing the infrastructure to that as well. So there's a lot of organic growth when we look at the business that we expect to come online for this business. And what's particularly interesting is that as this business is growing, it is an absolute free cash flow monster. It started off being a loss-making company, but then transitioning from FY19 to FY20, free cash flow was up some 17 times. It was obviously coming from a small base, so we shouldn't get too excited with that number there. But from FY20 to FY21, free cash flow was up another 170%. So it continues to print a lot of cash, and they're actually now at the point where management has that excess cash flow after reinvesting in the business for operations and for capex. They still have a fair bit of cash that they are starting to make capital allocation decisions around. So one of the things they're starting to do now is actually buying back some of the stock, which I guess makes sense, particularly now when companies have had a share price hit, I guess, with the broader market implications. So share buybacks is one option, dividends another option, and then just other growth initiatives that they have within the business. So they have different options that they can use this cash for. It's pretty useful that they have that option to invest the cash. And then just looking at the core structure of the business, it's got a very strong moat. As I mentioned, it's an infrastructure business. And once they partner with these properties, it's really hard to displace them for anyone else. So there's core growth opportunities that we like about this business. It's a free cash flow machine. It's got a great management team. They've actually demonstrated a lot that they've got the expertise within the industry to build what they have. And just more recently, there's been a lot of speculation. Actually, management have come out to kind of clarify what's happening. Certainly, big infrastructure funds, super funds are looking at this business. Multiple. They've received some offers, no clear details yet as to how much potentially someone would look to acquire them. I personally would like to see them stay on the Australian stock market rather than going private, because I do think there's a lot of opportunity for growth in this market. And I just think there's just a lot of recurring revenue for this business. So it's not the kind of business where you get that lumpy growth. You just get that steady stream of cash. And if you're acquiring that right now with the growth potential coming up, then I think it's a very good combination. And that's why we really like this company.
Very nice, Kaji. We'll get to the risks in a minute, mate, but you mentioned something there. I want to take the opportunity to help educate our listeners and viewers just a little bit, because you talked about the fact that you'd rather the company stay in the ASX than be bought out. Now, most investors, most people generally, and it's not an unreasonable thing, will say, hang on, if someone wants to give me $12 for my $10 stock, well, gee, that's an instant 20% gain. Why would I not simply go, thank you very much, that's spectacular. I just won a version of Lotto, unexpected, well, maybe some people think it might happen, but as you say, and you kind of, well, why would I look that gift horse in the mouth? Why would I say, no, please don't take, Uniti, please don't take $12. Please leave my $10 shares at $10. I'd much rather that. Now, I think some of our listeners and viewers will know the answer. Some will intuit the answer. But just give us the rundown, mate. Why would you knock back? It might be 20% gain, might be a 40%, might be 10%. But why would you knock back an instant gain that you can have right now in cold hard cash and say, no, don't take the money, stay on the market? What's the rationale there?
Yeah, so I think it's obviously always nice when you see your shares popping and there's a 20% premium that someone's acquiring the business for. But typically that's usually just a short-term gain that you're getting in the stock. So in your example, there's just a 20% gain, and with a lot of acquisitions, you're not really seeing that the premium go too much above 20%. So you don't really see like 100% premium on a listed business through a takeout or an acquisition. So the reason why we prefer the business to stay public and continue on to grow is because what we're looking at is, as long-term investors over longer periods of time, we actually think the business can deliver returns far beyond that. So even if the business delivers, say, 8 to 10% annualized over, say, a 10-year period or whatever, you're still getting far more than that 20% gain. Right. And we think there are more opportunities for the company to continue growing its business. So, yeah, we just think this, if you're a long-term investor, so if you're someone who's looking out beyond 1 or 2 or even 3 years, if you're looking way longer beyond that and you're happy to hold those shares and just happy to accumulate whatever dividends they eventually pay out or whatever else return you get from the business, we think if you combine all of that, even if you're discounting that back into today's present value, then you're still getting, we think you're likely to get more from that than a short-term 20% premium gain. So yeah, we think for long-term investors, it's just better to hold on to great companies than to sell them at whatever price they're selling at today.
I love it, mate. Thank you for doing that. It was a question without notice, but I thought it was a really good opportunity just to share some of that. Imagine Woolies being taken private at $5 or CSL at 30 or Commonwealth Bank at 10. You can see the sort of gains that some of these businesses have made since then. And having them taken out of our hands prematurely. I don't know any of those businesses for the record, but that kind of idea. Amazon now, $3,000. Imagine it being taken private at $150. The opportunity to accrue serious value from those great businesses would have been tragic. I own Amazon shares, by the way. Mate, let's go to the risk. But before we do, I'm going to throw my usual ad in, because if you're listening to this on the podcast, I'm going to assume you're a podcast fan, in which case I really would encourage you to listen to The Good Oil with Scott Phillips. Yes, it's called that. I have to put my name on it. The Boffins listener said to do that because there's other things out there called The Good Oil, other podcasts. So my apologies for sounding like I'm big noting myself. But The Good Oil with Scott Phillips is what you have to look for. You'll find some great conversations, including, by the way, we had some conversation with Kevin Gandiya, the man we're speaking with now. But you've plenty of business leaders, entrepreneurs, experts, a really great group. Honestly, I add almost no value to the conversation other than hopefully asking decent questions and getting out of the way. So don't listen for me. Listen for all the people that I speak to, because it's just lots and lots of fun. I have a ball doing it. I get lots of value, so do that. If you're not yet listening to podcasts, if you're watching this on YouTube, please do look up Motley Fool Money. We do 3 episodes a week there, plus The Good Oil. Great. If you're just getting into podcasts, great way to start. If you're already into them, hopefully some more listening that you might enjoy. If you're on those podcasts, by the way, also go to our YouTube channel. It's free, and it's at youtube.com/c/foolau, or simply just look up The Motley Fool Australia on the YouTube search engine. You'll find it really, really simple and easy. Hit subscribe, hit notify, so that next time Kevin's here or any of our crack analysts, you get the good stuff from them. Again, did I mention it's free on YouTube? Stock picks, conversation about stocks that are in the news, media appearances, all that kind of stuff, all on our YouTube channel, all for free. Check all those out. And of course, you want more from Kevin, because why wouldn't you? He's a smart bloke. Go to Twitter and look up Kevin Gandiya. Very simple, at Kevin Gandiya. While you're there on YouTube and Instagram, if you're looking for me, I'm at TMF Scott P. Or you can find The Motley Fool at The Motley Fool AU. And let me round this out with Facebook, because I'm there, facebook.com/Scott Phillips Money, or facebook.com/The Motley Fool Australia for our business account. Right, that's all out of the way. But seriously, like, lots of free stuff everywhere from The Motley Fool. Why would you not? Kevin, let's go to the risks, mate. I'm going to, assuming I talk about some of the risks, I'm curious, as we kick off, your thoughts on the acquisitive nature of this business. Great when they work, acquisitions, potentially big We've seen plenty of acquisitions go badly. BHP famously has made a couple of doozies. Roll-ups tend not to work. G8 Education, ABC Learning in the education space before that. They can be massive, massive value creators or massive risks for the business, particularly as they're changing their core businesses. It sounds like Unity's done over the last 3 or 4 years. Just talk us through the risks, mate, and touch on, if you weren't already going to, the risk of the acquisition-led strategy they've been pursuing for the last little while.
Yeah, absolutely. So I think acquisitions and just the process of integrating those acquisitions and actually extracting the maximum value from those acquisitions, I think that's the biggest risk facing this company. As an infrastructure play, it's quite expensive to actually put a lot of this core infrastructure together. So they've actually used a combination of their own equity and debt to actually put this whole package together. And so they do have debt on the balance sheet. They have been, now that they're earning a fair bit of cash, they're trying to pay that down. But the challenge is, in a lowish interest rate environment, management kind of go through this process of thinking, we could pay off debt at a very low interest rate, or we could do other stuff such as pay back our shareholders or whatever else with this cash. So they've tried to do a combination of both, and the debt has been reducing. I think now they have roughly $200 million in debt, which is a lot. They paid some $40 million the last financial year, but they still have that debt on their balance sheet. So if for whatever reason they don't get all that excess cash they're expecting from their investments, or if competition heats up and they don't sign up new orders with other property developers, or if interest rates go up and they're starting to pay more on that debt, then that presents a significant financial risk to this business. It is quite leveraged in that sense. So for now, we think the debt is manageable based on the cash that they have at the moment and what they're generating at the moment. But as with all things, it can be a risk. It's just like anyone. If you've got a mortgage and you lose a job, it can be quite scary just trying to manage that. So I think that's the first major risk. The other risk is, telecommunications is quite... It's quite an interesting business, but it can suffer from margin compression. Basically, it's difficult to really charge excess margins in this business, particularly if you're offering what's essentially a commodity type service. One of the good things about Uniti is that they own their core infrastructure, so their margins are higher than other telco companies. But it is highly regulated. It's hard to really squeeze that extra dollar and raise prices from your customers, and so just the process of managing all of that, it can be quite difficult to do and implement. So that's another risk. And then obviously as well, technological changes can impact the business. People can decide to use 5G or even Elon Musk's Starlink, which is basically a satellite dish that you install onto your roof. So there are different things that can happen within the space that can render some of this fiber infrastructure a bit not as useful. But overall, we think it still forms a core part of our core internet infrastructure. So that's helpful, but that's still a risk nonetheless. And then there's a risk with the management team. This is a very specialized industry. We're relying on the management team to continue to execute, to continue to use their contacts and expertise to deliver with this business. But people can leave. They may not be as incentivized to continue growing the business, so they could go elsewhere. So we're really relying on that core management team to continue doing what they've been doing and grow this business. So those are some of the risks that I'd be considering if I was looking at Uniti Group.
Love it, KG. Viewers, listeners, as you can tell, Kevin is an absolute tech guru, one of the best tech investors in the country, in my not so humble opinion. You want more from Kevin. Now, he runs Motley Fool Extreme Opportunities. I'm not going to do another full ad. All I'm going to tell you is you can sign up for our free email at fool.com.au/take-stock. That's our Take Stock email. You can find it at our homepage as well. But if you go to fool.com.au/take-stock. Now, full disclosure, we give you 2 or 3, maybe 4 emails a week on the market, normally written by me, occasionally by KG. We had one of those out on Tuesday this week. So jump on that. You will get marketing material from us. Now, that's annoying in some cases. It also gives you the best prices for our services, including Kevin's service, Motley Fool Extreme Opportunities. If you liked what you've heard today, and why wouldn't you? You can get more from Kevin and the team at Extreme Opportunities. Honestly, best way to get the best price is sign up to that email list. You can get it by a standard retail price if you want on our website. I'm sure the bean counters will be happy with that. But if you want the best price, Every now and again, we have an extreme opportunity sale. We're putting most of our services rotate through their best prices. And so extreme opportunities will be up very, very soon if it's not already. So fool.com.au/take-stock. Join the mailing list, get some free stuff from us, more free stuff, but also get some of our best offers, including the ability to join Kevin at Extreme Opportunities for, frankly, a price that I've said before, I think is too cheap. Just quietly, I'm campaigning behind the scenes to get that price up because it's worth so much more. But maybe it won't happen, maybe it will. If it does, get in now while the price is cheap. All right. KG, thank you, mate. The last thing I want you to do for me, if you wouldn't mind, is wrapping the whole thing up. You give us our 30-second, 60-second elevator pitch, as I say. If we jump in the lift, go from the 1st to the 31st floor. Give me the quick summary of why our listeners should consider, and our viewers, should consider buying shares in Uniti Group, mate.
Yeah, so with Uniti Group, you're buying a strong and defensible business. It's really hard to displace this core infrastructure. So there are good chances that this business will be around for a long time to come. You're getting good growth prospects. It's really hard to get that combination of a strong infrastructure business and strong growth. So you're getting that unique combination with this business. And also it's profitable. It also generates GAAP profits and also cash. So it's also it's got that good combination of profit and cash flow, and it's using that cash to find all the different options to generate value for shareholders, whether that's dividends or share buybacks or finding other growth options. And you've got a great management team who've proven what they can do in the telco space. They've worked pretty much in most of the major telco companies in the country, so they know the landscape really well. So I think overall that's a very good package. Yes, there are risks as we discussed, but I think overall that's a good company to be looking at for potential investment.
Sensational. As we always say, do it as part of a diversified portfolio. Last couple of thoughts from me. The usual things I put at the beginning, I'm going to put at the end today, just to mix it up a little bit. Firstly, Kevin is giving you general, not personal advice, so consider how it works for you. And as I said, be diversified. It makes sense no matter what the company we're talking about. Secondly, it's a buy right now. On the 25th of January, as we're recording this, the day before Australia Day, we reserve the right to change our minds. We do regularly, not all that often actually, but if the circumstances change, if the price goes up or down, the business gets better or worse, we'll reassess and change our minds. So it's a buy right now. We don't expect that to change anytime soon, but just know if you're watching this months or listening to this months or weeks or years later, the view may have changed. Just be mindful of that. Lastly, we're long-term investors. Kevin and the team are looking out 3 to 5 years and more. We're not forecasting or expecting that the price might go X, Y, or Z tomorrow or next week or next year. We're simply saying in the long term, we think this is cheap. We think it's a market beater from here over that extended time period, which is the right time period for any investor. So do keep that in mind. KG, thanks again, mate, for sharing your expertise and your time with us. I certainly have enjoyed it and appreciate it. I'm sure our listeners and viewers do as well. If you're listening to or watching this, thank you for your time. We know there's so many other things you could be doing with it, and we appreciate you spending some time with us. Why wouldn't you when people like Kevin are on the podcast, on the YouTube channel? But we still appreciate you could be doing anything else, so we do appreciate it, and we hope it's been valuable for you. All that's left for me to do is say on behalf of Kevin, myself, and the whole Motley Fool team, until next time, Fool on.